Hello, it's Jeffrey Christian of CPM Group. I want to back away from talking about current market conditions in the precious metals markets and talk about longer term global economic activity. Global economic activity has a lot to do with investment demand for precious metals and consequently precious metals prices. And there are shifts in global GDP which have been important to gold and will continue to be important to gold and silver. This is global GDP from 1960. And you can see 1960 into the early 70s, relatively strong real global GDP. And about 45% of that was in the United States. Other parts of the world had various issues that were restraining economic activity and growth. 1974-75, we had the first oil embargo and a deep recession on a global basis. It shows up here as low annual data because you can have 2 or 3 quarters in a recession, but if you have a strong quarter prior to that recession or a strong quarter in the first quarter after the recession, which is typical in a recovery, you can have low annual positive GDP expansion, even though you've had 2 or 3 quarters of contraction. You saw that in 74-75. You saw it again in 1980, 81-82, 91, 2001. The big Great Recession, we actually saw annual negative growth, contraction of economic activity in 2008. That recession lasted from late 2007 into early 2009. It was one of the longest recessions that we had had since the 60s or 50s. And then we had the big recession in 2020 with the global lockdown in response to the COVID panic. Now, by the time you got into the aughties and into the teens and into the 20s of this century, U.S. GDP had contracted to around 22% of global GDP. Still the largest economy, but other economies had been growing up. And they had been supported by U.S. government policies. U.S. government said international economic activity, international trade are good for the U.S., good for the U.S. economy, good for U.S. companies, good for U.S. workers. And we encouraged it. There were some divisions within U.S. government policymakers and economists, but that was, generally speaking, the policy into around 2004, 2005. At that point, there was a very overt, publicized, admitted shift in U.S. policy away from being as cooperative on a global basis to being more competitive. And it partly reflected the fact that the U.S. was losing some stature on a global basis in terms of percentage of GDP, in terms of economic activity, and a variety of other issues. Now, as those other economies recovered and grew and became more important, there was some bristling at U.S. hegemonic attitudes toward them. And in 1989 in Japan, this is Japanese GDP, annual year-to-year growth or contraction in the case of 1974, from 1957 to 1990. I'll show you an extension in a second. Japanese miracle of the 1950s and 1960s led to stronger growth. There was a slower growth after the first oil embargo in the late 70s and 80s, but it was still very positive, and it was often it was typically over 3% and sometimes as high as 6% or higher real growth in Japan. And by 1989, there was an essay that was written. It was turned into this book in 1991 called The Japan That Can Say No. And the attitude expressed in this book was, we've had to kowtow to some extent to U.S. policies, but as we've gotten bigger and stronger, we can actually stand up to the U.S. government and say, no, we disagree with you about this or that. I remember it very well because we were sitting in our office. We do a lot of work with Japanese companies. And when you're doing work with Japanese companies or Australian companies or Chinese companies, companies in those time zones, as a consultant, you tend to speak with them at your night or early morning, their office hours. And I remember very distinctly getting a call from one of our Japanese clients one day in our working hours. He was calling from his home at night to tell us about a meeting between the Ministry of Finance, the Bank of Japan, the Japanese government, senior policymakers, and various banks and brokerage houses, in which they were bristling with each other over what to do. And that marked a significant change in the way Japan Inc. operated. And you could see this with a sharp decline in GDP. And then there was the lost decade, a period of extended, very low GDP in Japan from 1990-91 into the new century. And then that lost decade turned into a lost quarter century. And it's very interesting, and I don't necessarily want to offend Japanese people, but as they came to see that perhaps they could stand up to the United States government and have a greater role in the world, domestic policies changed in such a way that led to a quarter century of very anemic growth, coupled with a variety of other factors too, including changing demographics and the rise of competition from Korea, Taiwan, and ultimately mainland China, and Thailand, and Malaysia, and Singapore. So the Japan that could say no came out at exactly the wrong time, unfortunately. In 1996, a Chinese economist wrote a book, Chinese translation, that said, China can say no. And you can see here, this was at a period of time when GDP had been very strong, more than 10% for 4 years, and it was actually declining. We had a decline in the late 1990s, but then it came back roaring up until 2006, 2007, and it's been contracting since then. Now you have to understand, these are percent changes in growth of real economic activity. As an economy grows, the same amount of increase in actual economic activity is a smaller percentage of the base of what was activity. So part of the decline that you saw from 2008 to 2018, 2019 was math. It was arithmetic. It was, you're looking at the same amount of economic growth in some cases more than in the previous year, but measured against a higher base, it looks like lower growth in percentage terms. 2020 came along. They had a strong recovery in 2021. They came off in 2023. Our expectation is that in 2023, real GDP in China will be about 4.25% growth. They've had a couple of really good quarters this year so far. So again, it's like we want to stand up to the United States and Europe. We want to say that we demand and we deserve a better place at the table in terms of international economics, politics, society, currency markets, financial regulation. But the timing has not necessarily been that great. It's sad. It contributes to the breakdown in international cooperation. It contributes to bad economic policies and foreign policy, political policies, international policies on the part of the U.S. government. And it's one of the things that has been plaguing the world and probably will continue to plague the world for the next unforeseen number of years, increasing the risks and uncertainties in the market, stimulating investment demand for gold and silver, and keeping gold and silver prices high. That's all I have right now. A little bit of a discussion, but at the end of the day, gold and silver prices are determined by investment demand, and investment demand is primarily determined by the way investors look at the world in terms of their economic well-being, their political well-being, and financial stability, and the stability of the financial system that they rely on and live within. You can go to our website, order our yearbooks, order other research consulting services. You can send us an email at info@cpmgroup.com and say, this is how I think CPM Group can help me either protect myself and my wealth through precious metals, or seek capital appreciation, or our preferred method looks to do both capital preservation and capital appreciation using precious metals and commodity investments. Take care of yourself. We'll talk to you next week.